Sometime in the middle of October, the Social Security Administration will announce a single number. That number decides how much your check goes up in January. And based on the projections out right now, it could be the biggest raise you've received since 2023. That's the headline you're going to see everywhere this fall. Here's what those headlines will skip. There are two things waiting for that raise before it ever reaches your pocket. The first one is deducted straight out of your check, automatically, before the money touches your bank account. The second one is quieter. It's a line in the tax code that hasn't moved since the 1980s, and every raise you've ever received has pulled you a little closer to it. This year's raise, if the projections hold, will pull harder than usual. Over the next 20 minutes, I'll show you what the projections actually say, how this number really gets calculated, including why nobody on Earth knows the final figure yet, the honest history behind the phrase biggest since 2023, both of the things that will eat part of your increase, and the handful of moves you can still make before December 31st. Let's get into it. First, the projections. And I want to be careful with my words, because these are projections, not announcements. Nobody, not me, not any channel, not any newsletter, knows the official number yet. Anyone who tells you they do is guessing. The Senior Citizens League, an advocacy group that tracks this every single month, currently projects the 2027 cost of living adjustment at 3.8%. AARP's forecast sits slightly lower at 3.6%. For comparison, the raise you received this past January was 2.8%. What would 3.8% mean in dollars? For the average retired worker, roughly $74 more per month, bringing the average benefit to a little over $2,000. Your own number depends on your own benefit. A bigger check gets a bigger dollar raise. A smaller check gets a smaller one, because it's a percentage, not a flat amount. And if 3.8 holds, it would be the largest adjustment since 2023. Now, before you celebrate that phrase, I want to be honest with you about what it actually means, because this is where most coverage gets it backwards. The COLA is not a reward. It's a thermometer. A big COLA doesn't mean the government got generous. It means inflation got worse. The 8.7% raise in 2023 wasn't a gift. It was the receipt for the worst inflation in 4 decades. The 5.9% the year before that, same story. And the 2.8% you got this year was the smallest since 2020, which, read correctly, was actually the good news that prices had cooled down. So, when the projections say 2027 could be the biggest since 2023, what they're really saying is the prices you're paying right now, this summer, at the grocery store, at the pharmacy, are rising faster again. The raise is the echo of pain you've already felt. Keep that in mind every time you see a celebratory COLA headline this fall. So, how does this number actually get calculated? This is worth 3 minutes of your time, because once you understand it, you'll never be fooled by a COLA prediction again. The law ties your adjustment to a specific inflation measure, the Consumer Price Index for urban wage earners and clerical workers, CPIW. And here's the part most people don't know. It doesn't use the whole year. It takes the average of just 3 months, July, August, and September, and compares that average to the same 3 months from the year before. The percentage difference between those two numbers is your COLA. That is the entire formula. Think about what that means right now, in August. We are living inside the measurement window at this very moment. July's inflation data is already in the books. August is being written as we speak. September hasn't happened yet. That is exactly why the projections keep shifting month to month. Each new inflation report fills in another piece, and why the official announcement comes in mid-October, right after the September number is published. So mark your calendar, mid-October. That's the day. And I'll break down the official number on this channel the same day it drops. So if you haven't subscribed yet, that's the practical reason to do it now. One more thing about the formula, because your gut has probably already told you something is off about it. CPIW measures the spending of urban wage earners, working people. But retirees don't spend like working people. You spend more on healthcare, more on housing, less on gasoline and commuting. Advocacy groups, including the Senior Citizens League, have argued for years that the formula should use a different index built around what older Americans actually buy, because the current one tends to understate the inflation seniors really face. Congress has never made that change. I'm not here to tell you it will or won't happen. I'm telling you so that when your raise never quite seems to match your grocery bill, you know it isn't your imagination. It's the formula. All right, now let's talk about the first thing that eats your raise. It's called Medicare Part B. And for most of you, it takes its bite before the money ever reaches your bank. If you're enrolled in Medicare, your Part B premium is deducted directly from your Social Security payment. This year, the standard premium is $202.90 a month. And here's the recent history that should have your full attention. Last year, that premium jumped nearly 10% in a single step, from $185 to $202.90. For a lot of people, that one increase swallowed a meaningful slice of the 2.8% raise before they ever saw a dime of it. What about next year? The official projection from the Medicare Trustees Report puts the 2027 premium at around $209.50, an increase of about $6.60, or roughly 3%. If that holds, it would actually be one of the gentler increases in recent years. But I'll be straight with you, because this channel exists to tell you the part they skip. Several private forecasters who track this closely expect the real number to land higher, somewhere in the 215 to 219 range. Their reasoning is simple. The trustees have underestimated the actual premium in several recent years, so they treat the official projection as a floor, not a forecast. Last year's trustees report, for what it's worth, projected a different number for 2027 than this year's report does. These estimates move. The official premium gets announced by CMS in November, so notice the sequence of this fall. Your raise is announced in October. The deduction that eats part of it is announced in November. You will know both numbers before the first adjusted check arrives in January. While we're on Medicare costs, two changes on the drug side are already locked in for 2027, and you'll see them in the plan paperwork arriving this fall. The annual out-of-pocket cap for Part D prescription coverage rises to $2,400, and the standard Part D deductible rises to $700. The cap going up is the ceiling on your worst-case drug costs. The deductible going up is money out of pocket sooner. Different plans handle these differently, which is exactly why the open enrollment window in October matters, and I have a separate video coming on that. Now, there is one safety net in this whole Part B story, and most people have never heard its name. It's called the hold-harmless rule. In plain English, for most people who have their Part B premium deducted from Social Security, the law generally doesn't allow a Part B increase to cut the dollar amount of your check below what it was the year before. Your raise can be reduced to zero by a premium jump, but for most protected beneficiaries, the check itself can't shrink from one year to the next because of Part B alone. Two honest caveats. It protects the check from shrinking. It does not protect your raise from being eaten. And not everyone is covered. People paying income-related surcharges, people new to Medicare, and people not yet drawing Social Security don't get this protection. If that's you, the full premium increase lands on you directly. The details are on Medicare.gov, and they're worth 5 minutes of your time. That's the first eater. Visible, automatic, announced in November. Now the second one. The second one is quiet. Almost nobody connects it to the COLA, and it's the only one you have real control over. Here's the setup. Whether your Social Security gets taxed at the federal level depends on a number called provisional income. Roughly speaking, your other income, withdrawals, pensions, interest, dividends, plus any tax-exempt interest you earned, plus half of your Social Security benefits for the year. If you file single and that number stays under $25,000, none of your benefits are federally taxable, not a cent. Married filing jointly, the line is $32,000. Cross those lines, and a portion of your benefits starts being counted as taxable income. Past $34,000 single or $44,000 joint, the maximum share that can be counted rises to 85%. And let me kill a myth right here, because it scares people every single fall. 85% is not a tax rate. Nobody takes 85 cents of your Social Security dollar. It's the maximum portion of your benefit that can be added to your taxable income, which is then taxed at your ordinary rate, whatever that is. For most retirees, that's a 12 or 22% bracket applied to a portion of the benefit. Painful, maybe, but not 85% gone. Now, here is the part that should genuinely bother you. Those thresholds, $25,000 and $32,000, were written into law in the 1980s, and they have never, not once, been adjusted for inflation. $25,000 was a very different amount of money 40 years ago. The line has not moved an inch since. Meanwhile, what happens every January? Your benefit goes up. The COLA raises it, and half of that bigger benefit flows straight into the provisional income formula. So every raise pushes your number a little higher, toward thresholds that are standing perfectly still. Watch how quiet this is. Nobody passes a new law, nobody holds a vote, nobody sends you a letter. But the arithmetic does the work anyway. Every single year, some retirees who have never paid a dime of federal tax on their benefits quietly cross the line for the first time. And the bigger the COLA, the more people cross in 1 year. A 3.8% raise would push more people over the line than last year's 2.8 did. Let me make it concrete. Picture a single retiree whose provisional income sat at $24,600 this year, comfortably under the line, zero tax on benefits. Now give her benefit a 3.8% raise. Half of that increase flows into her formula. If it carries her past $25,000, then for the first time in her retirement, a slice of her Social Security becomes taxable, not because she did anything, not because any law changed, but because her protection was standing still while her benefit walked forward. That is the trap. And it tightens on its own, every year, precisely because the thresholds don't move. There's one more twist to the big COLA story, and I'd rather you hear it from me than from a scary headline. A larger COLA also costs the Social Security system more. The Committee for a Responsible Federal Budget has estimated that a raise in this range would move the trust fund's projected depletion date a few months earlier into late 2032 territory. I've made a full video on what that 2032 date actually means and what it doesn't, and the honest version is far less terrifying than the headlines. The link is in the description. For today, just know, the same inflation that raises your check also raises the system's bills. Both things are true at once. So the raise, you can't control. The Part B premium, you can't control. The provisional income number, that one has levers, and the end of this year is exactly when they matter. The formula counts your other income, which means the source you withdraw from matters. A withdrawal from a traditional IRA raises the number. A qualified Roth withdrawal doesn't enter it at all. If you're 70 and a half or older and you give to charity anyway, a qualified charitable distribution moves money from your IRA to the charity without it ever touching your income. and it can count toward your required distribution at the same time. I've covered both of these in detail in other videos on this channel, and December 31st is the deadline that matters for most of them. And one practical step almost nobody takes. In December, SSA sends you a letter with your new 2027 benefit amount. When it arrives, don't just read the number and file it away. Ask one question. Will this raise push more of my benefit into taxable territory? If the answer might be yes, you can have federal tax voluntarily withheld from your Social Security by filing a short form with SSA, Form W4V, choosing from a few set percentages. Fixing the withholding in January is a 5-minute task. Discovering the shortfall at filing time in April is a much worse afternoon. Let me put the whole picture together. The projections right now say 3.6 to 3.8%, the biggest raise since 2023, if it holds. The real number gets built from July, August, and September inflation data, a window we're standing inside right now, and announced in mid-October. It's a thermometer, not a gift. A big number means prices have been climbing on you all summer. A quick note. This video is educational information only, not tax, legal, or financial advice. IRS Tax Guide USA is an independent channel, not affiliated with the Social Security Administration, the IRS, Medicare, or any government agency. Verify everything you hear at ssa.gov, medicare.gov, or irs.gov, or with a qualified professional. Medicare Part B takes the first bite, announced in November, deducted automatically. Officially projected around $209.50, privately expected higher, with a hold-harmless rule that protects most checks from shrinking, but nobody's raise from being eaten. And the frozen thresholds from the 1980s will quietly pull another wave of retirees into paying federal tax on their benefits for the first time, because the raise moves and the line doesn't. October, the COLA. November, the premium. December, your benefit letter, and your last chance at the year-end levers. January, the first adjusted check. Everything I've cited comes from ssa.gov, the Medicare Trustees Report, and IRS Publication 915, all linked below. These are projections until October. Verify the final numbers when they land, or sit down with a CPA or enrolled agent about your own return. If this was useful, subscribe, because the day the official COLA number drops in October, I'll have the full breakdown right here. What it means for your check, what the premium news means, and exactly where those tax lines sit for you. And tell me in the comments, did last year's Medicare premium jump eat part of your raise? I read every answer, and the most common story becomes the next video.